Investors Chronicle.
Welcome to the Companies and Markets Show, the podcast that gives you expert analysis on all the latest market and listed company news. I'm your host, Dan Jones, and this is what you need to know. After a fortnight of turbulence, it's been a calmer week for markets, but there is still plenty of uncertainty in the air as the reverberations from Donald Trump's tariff policies continue to ripple across the world. As first quarter reporting season begins in the US, we're seeing companies pull guidance or just sound much more cautious in general. Today, though, we're going to kick things off with some full-year figures from UK components manufacturer TT Electronics, which has had its own problems to deal with, as well as a load of tariff unease now thrown into the mix too. Mike Fahy and Arthur Sants will be taking a closer look shortly. Then we move on to the latest developments regarding the tariff and trade policies themselves. If you're struggling to keep up, we'll discuss all the latest moves affecting companies like Apple and Nvidia, the many difficulties now facing the US Federal Reserve, and what all this means for valuations and US shares' future prospects. We return to the UK to wrap things up with a look at motor finance and bridging lender S&U, whose own full-year results have been overshadowed by the ongoing regulatory probe into motor finance commission arrangements. Mark Robinson will guide us through those figures. TT Electronics is first up, though. Mike, I'll start with you. Can you set the scene a bit before we discuss the figures themselves? Because there's been a fair amount going on with the company in recent times, recent months and years.
In recent weeks as well.
Well, yes.
Yeah, so it is as you mentioned, components maker. It makes all kinds of sensors, actuators, switches, that kind of thing for a variety of markets, doing in a variety of different states. So it's kind of bread and butter is automation, but it does some work for aerospace and defense, which is doing very well, and for the healthcare industry, which is not doing so well. It became the subject of a bid last year from Volex, which we can talk about in more detail later, who were targeting it mainly because it's just hadn't been delivering on its promises. It frequently talked about achieving an adjusted operating profit of 10% or more, which it had failed to hit for several years in a row. In fact, on a kind of statutory level, it's declared losses for the past 3 years, and last year its sales fell by about 15%. So, not a great performance.
Well, let's talk about the figures themselves. You alluded to some of the detail there. Arthur, you cover them for us. What did you make of the full year figures in a general sense, and maybe regionally as well, where things are going reasonably well and where things are going quite badly?
It was sort of a microcosm of the end of US exceptionalism story that's been going on, because their revenues sort of split. It's more skewed towards the US, but it makes a significant amount of its revenue from Europe as well. And it's, as Mike said, mostly like aerospace and defense demand. So the US, while the US was sort of struggling, Europe was actually performing quite well, and in terms of revenue growth. And on top of that, those trends look probably set to continue, with the German debt brake being taken off and then sort of opening up to more defense spending, and Europe seemingly wanting to spend less on US defense and spend more on its domestic European contractors. It feels like that divide could continue. So if growth prospects in Europe are improving, then American ones might be degrading. They've also got manufacturing plants in Mexico and China, so there's obvious issues there with if they're making their components in Mexico and China, particularly China, how they'll get them into the US at a reasonable cost, which I think is some of the main issues surrounding the US.
Yeah, as you say, it could be seen as a bit of a microcosm for the way the world may be going. We'll see how that unfolds, albeit TT Electronics has had problems in the US for a while, so it's not really reflective of, not really entirely solely reflective of underlying economic issues. It's had some problems with efficiency in its North American plants, I think, and has been doing remedial work there for a while. There was also a change in management alongside these results, which has been quite a quick turnaround. A new CEO has come in, who is himself the new CFO.
Yeah, so the results themselves were delayed, which is never a good sign, or usually not a good sign. And there was, as you mentioned, the performance issues in the US really caused quite a drag. There were some big impairments made, and there was even like a going concern notice in there, partly highlighting the threat from the business of tariffs, as Arthur's just mentioned, and just the uncertainty of the outlook. But given that that Peter Francis came in last, who was the chief executive, who's gone, had come in, as you mentioned, not so long ago, and was attempting a turnaround of the business, which clearly wasn't working, and that they'd had an offer from Volex, which, albeit it was substantially higher than the previous couple of weeks, but it was still quite a drop on where the shares had been trading even a couple of months earlier. But to reject that and to then continue to do so badly meant that it probably had to go.
So it'll be interesting to see, of course, with the new board, well, certainly with the new CEO in place, skipping ahead a bit here maybe, but whether Volex comes back. Clearly there's a lot more uncertainty around the business with the tariffs situation. Things haven't really improved, but equally the share price is another 45% lower than I think Volex's final offer at the end of last year. So
yeah. The thing about the Volex offer as well that also might have made it less attractive to shareholders looking even on a short-term basis was the fact that less than half of it was in cash, and the Volex were obviously talking up their own ability to integrate acquisitions, which is one of the areas it was critical of TT for not integrating very well. But then when you look at, okay, so TT shares are down quite a bit, but Volex's shares have also been hit slightly by tariff concerns. And
that's a fair point, yeah. I mean, I think they're down about 30% over 6 months. So
yeah. So
their own
that
ability is
that shares element would be worth a lot less. But still, the amount by which they've fallen, I think they're trading at 75p now. And there was 63 of Volex's offer, which was in cash. So you would think that had they taken it, the shareholders would be in a slightly better position now.
Yeah. Arthur, we downgraded them on the results, cutting our losses perhaps in a way. They're on hold at the moment, which, I mean, a lot of companies perhaps is hold as a decent assessment right now because the companies themselves are struggling to forecast the future and provide much insights to how they'll fare. But can you say a bit more about that decision? I mean, given everything we've spoken about, it seems a reasonable one, but what was your thinking there?
Yeah, I was sort of on the fence between what to do there, and its sort of valuation had come down so much, and like it's fallen below its net asset value. And then I was thinking that maybe Volex would want to come back in and offer some premium to the current share price, but it would be a discount to the previous offer. However, I feel the issue, as you said, at the moment with the uncertainty is also I feel like how much the assets are even worth under new conditions. Like if you have a bunch of manufacturing plants in certain countries, but then there's a trade war or potential trade war, you don't know what direction we're going with restrictions, how much are those assets even worth going forward? And presumably if this continues and the US is very serious about sort of walling itself off, then there'll be a lot of accountants running around to try and figure out how much assets are worth now and impairments being taken. So under that uncertainty, I went down to a hold, but I feel like that at the moment is kind of my feeling about almost every company. So
yeah, it's difficult.
PTI Drugs is obviously was going into this already under a lot of strain, whereas I think you want to be owning companies that are coming into this with a strong balance sheet and are performing well rather than the other end of the spectrum.
Indeed. Equally, if they do get their act in order, as we're writing about in next week's issue, there is a situation, very much the glass half full or glass completely full scenario where they start operationally improving just the time when a turnaround arrives. Economically, we're clearly still some way out from working out what's going on economically, so that's not yet happening, but something I guess one should always be aware of there. In terms of what they said this week, they've lowered their guidance a little bit, haven't they, for 2025. They see a wider range of potential outcomes for 2025, which we all do, given what we've just said, I think. But yes, clearly a lot needs to go right for them at the moment. Let's talk about the tariffs themselves, though. We've spoken about them on the last couple of shows. There's no avoiding them. There's been plenty more news flow over the past week as well. Why don't we start with looking at what has been said over the past week or what has affected Apple and Nvidia in particular? Nvidia is not so much tariff as more a trade restriction, as we'll get to in a minute. But let's start with Apple, because last week there was this, once again, a bit of back and forth, wasn't there, in terms of how it might be affected by China tariffs and other tariffs that may come in. What did you make of it, Arthur?
Correct me if I've missed any bits of the story, because there feels like there's always so many announcements going on and social media posts from Trump that it feels a little like a waste of time to be following the announcements extremely closely, because then suddenly there'll be a subsequent announcement that will completely change everything. For example, with the writing of the feature, we had to have a last minute scramble to add in the Apple exemptions. So they, having put the 145% tariff on China, which obviously would massively increase the cost of the iPhone, because most of them, they've been trying to diversify into Vietnam and India because the China trade war has been bubbling up for the last 5 or 6 years, but they only managed to move 20% of the supply chain away. So the price of an iPhone overnight was going to go up massively, assuming Apple had to pass on a lot of those costs to consumers. And then the Trump administration announced an exemption for for consumer electronics, semiconductors, and others electrical components that would be coming out of Asia. But then the story then went that Trump tweeted that there was no exemption, and then Howard Lutnick came out and said that they would come up with specific tariffs in the future for electronics and semiconductors that would be announced in due course. So Apple's share price bounced up a lot on the exemptions for consumer electronics for obvious reasons. What then happens going forward is obviously more uncertain. In the first Trump administration, a lot of analysts have been predicting this, because in the first Trump administration, he gave an exemption to Apple because he put on the tariffs on China, and then Apple came to him and struck some kind of deal, and then Trump offered them an exemption. So a lot of analysts were already anticipating that some sort of exemption would come Apple's way before it was announced. And I'm sure the market now priced into its shares. So in lots of ways, it wasn't unexpected. I think what the good thing is, right, for Apple is that it shows there are some guardrails on Trump and how far he'll go with it.
Yeah, and it does seem we're waiting. There was a suggestion that the semiconductor sectoral tariffs, similar to automotive tariffs, which have already been announced, there was a suggestion they be announced this week. That hasn't happened yet. But at the very least, again, taking the automakers as an example, it does seem that figure is 25% for cars. Even if that's the same for semiconductors, that's still a big tariff, but it's nowhere near as big as the 145% China tariff. So clearly the situation is better than it was. We'll see what happens there. Let's talk about Nvidia, because, again, this is slightly tangential, but that came out this week. There was a bit of a hit to their share price the other day because there's been a further clampdown in short on what they can export to China as well.
Yeah, so this has been going on for a while, and this was going on under the Biden administration, which is around how powerful a chip can Nvidia export to China. And the US has been trying to choke off their access to the most powerful Nvidia chips. Then Nvidia kept on designing sort of chips that came in just below whatever threshold the government had set, so that they could then export them to China. And the Chinese, presumably for whatever they were getting their hands on, have managed to do a pretty good job, because there was feels like a while ago now, but actually wasn't that long ago, at the start of the year, when was it the start of the year or right at the end of last year? But
It was the start of this year, yeah. You're right. It feels a lifetime ago already.
Yeah, it feels so long ago, when DeepSeek released their AI model, which caused a spark to sell off in the technology market, because that model, which performed on par with OpenAI and the other big US models, was made with whatever chips the Chinese were managing to get their hands on, and it was less power intensive and required less chips to perform at that level, which was what sparked the sell-off. But clearly the US is concerned around what the Chinese can get their hands on. There's two arguments there, right? The one argument is that the more they try and choke them off, the more the Chinese companies will adapt and become more efficient with the chips they use. But Nvidia has had to take a $5.5 billion hit to its profits because of these restrictions and what it can or now cannot export to China, and chips that they previously thought it would be able to export and now are coming under the restrictions from the US. It'd be interesting, but China also has a bunch of tariffs on US imports, but I guess those chips that Nvidia would be exporting to China would be coming from Taiwan into China, and presumably China wouldn't want to be putting all these extra costs on some of the electronics it's been getting in. So that's the main issue, right, is that it goes both ways. And then once the trade war is started, you don't really know how it's going to end or where the escalation is going to go. So this is an export control from the US. They're trying to stop the chips from getting into China. But you never know how anyone is going to retaliate each way, which is part of the added uncertainty. And then this caused Nvidia's shares to drop 6%, but also there was a sell-off across the whole semiconductor sector. A, because it increases risks of these sort of controls for other businesses. Qualcomm, AMD sold off a lot.
Let's talk about some of the US companies that could ride through this turbulence, though, because as part of the big read this week, which you've written on tariffs, you've calculated or looked at some companies with strong balance sheets in particular via a series of metrics in an attempt to try and ascertain which businesses are best placed to, as I say, ride this out, to endure whatever economic uncertainty we see in the months ahead.
My theory there, when I was trying to think about what companies would potentially prosper in this period, some people will make specific sort of sector or company arguments. So there was one made for an analyst I talked to was making an argument for some of the like Martin Marietta and Vulcan Materials, which are concrete manufacturers in the US, because all their supply chains are domestic, they won't be affected directly, and there'll be investment in housing, etc. But the main problem with this regime is there are companies that will be specifically affected more than others. But generally, if it has increased recession risk, recessions are bad for almost every business. So it's hard to sort of escape and or know what's going to happen. In the long run, you should be invested in equities. But in the short run, there'll be companies that are sort of most resilient. They'll be able to deal with the turbulence. And resilience comes from having a strong balance sheet and good cash flow generation. And actually, those sort of companies can even grow and prosper in the long run, because if equity values are coming down, asset values are coming down, it's the companies with the strong balance sheets and lots of cash. They can either buy back their shares or acquire other businesses at a discount from what they were valued earlier, based on a few metrics like operating margins and net debt figures. I made a ranking of and return on equity. I made a ranking of the S&P 500 companies, and then included the companies that came out highest on that ranking method. A lot of them were software companies, so like Meta and Nvidia and Alphabet and Visa. And then there were actually some chip manufacturers and equipment manufacturers in there as well. So like Lam Research and Applied Materials. This was an idea that was slightly given to me by Citi analysts who believe that the big tech companies with their strong cash flows and good balance sheets could be in a position, because their share prices have come down a lot, to do quite big share buybacks while the market is suppressed. And on top of that, they can boost their cash flow by pushing out their big capex requirements, because they're spending, or they've committed to spend a lot on chips to build out their AI data centers, which are sort of nice to have rather than must have to a degree, although I'm sure that they would argue they're a must have. But if there is a real big slowdown or they're very unsure about what's going to happen, that's the kind of spending that can easily be pushed out into the future to increase their cash flow a lot, and then that can be used to do share repurchases. So those are the opportunities available to businesses with sort of those strengths.
Yeah, I think, that's certainly a fair enough argument. For me, there's going to be some uncertainty over these companies just because they're so affected by the macro, and also so affected by having led the market for so long, that when we do get volatility in the S&P, it is invariably these companies that struggle at the moment, because they're such large parts of the index nowadays, that's not really a valuation argument as much as a macro one, I suppose, pretty hard to justify in some ways. You can't base your investment decisions on macroeconomics entirely, but clearly right now it's something to factor in. Let's talk about what's coming up as well, though, because we have started to see, as I said at the top, some first quarter figures come out. Some companies have pulled guidance. Some companies, United Airlines yesterday, split its guidance, effectively saying this is what we think we'll earn in a neutral-ish scenario. This is what we think we earn if tariffs and various uncertainties continue. Next week, we've got a huge number of company earnings, including some of the tech companies, Q1 earnings admittedly only, but Alphabet, Microsoft, Tesla. You've got consumer staples like Pepsi, you've got Exxon, you've got Ford, Caterpillar, obviously a big bellwether as well. So we really could learn something next week in terms of the guidance, but equally, perhaps it's fair to say we won't necessarily learn that much from the figures because Q1 is really before all this has started happening. And in some cases, for some companies, people may even be bringing purchases forward, knowing that tariffs were coming down the line, whether those people be consumers or whether they be companies trying to get ahead of things as well. So maybe it's fair to say we might have to wait a little bit longer for some more information, albeit the guidance next week will be interesting as well.
There was also the Chinese GDP numbers were pretty strong, which is probably for the same reason that people were pulling forward their orders. So if you're importing from China, you try and get all of those imports in before the tariff announcements went in, which I'm sure will be the same with lots of these businesses. But for the consumer discretionary ones, it will be interesting to look at their inventories and the cash flow impact to see if they've sort of been spending a lot to ramp up their inventories, which we'll keep an eye on.
Indeed.
I'm not sure. It's going to be a lot of forwards guidance and split guidance, and it reflects all of the analyst reports I've been reading as well, which is a massive range of cases. So this is the bear case, which is like 25% tariffs. This is the base case, which is 10%, and the bull case is 5%. I think that was the problem with the Liberation Day announcement, was it was so far above any of even their bear cases, the effective tariff rate. And even the effective tariff rate now is way above all their bear cases, even with I don't know how it's come down since the consumer electronics exemption, but before that, when it was everyone else on 10%, when China on 145%, it was still the effective tariff rate. So I was seeing was still way above 20%, which I imagine makes creating full year guidance particularly problematic. But it'll be interesting to see which bits of the supply chains are impacted and how they're thinking about how these prices are passed on, because it's the companies with the how they call it pricing power that will be the ones that can pass on the majority of their prices to the consumers, where it's the ones with less pricing power that will have to absorb more of them. And usually it's some sort of 50-50 split where they have to absorb some of them and pass some of them onto the consumers. So those will be the most interesting line of questioning from analysts to see how confident these businesses are of passing on the prices. But the problem with passing on the prices is you need a strong consumer. And if the consumer is weakening because you're moving into a more recessionary environment, there's always going to be a limit to how much of that can be passed on, which kind of brings me to the fallacy of Trump's whole policy, which is he sees which you can see with the formula they used initially to calculate them, which was total US deficit divided by their imports, is they just see the deficit in general as something that needs to be removed or something that's ripping off the Americans, in Trump's words. And the only way you're ever going to get rid of that deficit totally is to impoverish the US consumer, because it's the reason why the US has that deficit is because they're an extremely wealthy country. And if that's his aim, which is to completely remove that deficit, the sort of monkey paw situation is his aim is also to make the US consumers poorer so there's less demand from them for foreign goods. And we'll see how long that situation can last, or whether he caves in. But I think companies will be sitting on their hands until then, waiting to see whether he caves or whether he's serious about this plan he has, or if he even has a plan.
Indeed. Well, we should move on shortly, but before we do, I just want to recap on the Fed's difficult situation it's in as well. There were some comments from Powell yesterday which caused a little bit of a sell-off, but by recent weeks, I think the market closed down 2.3%, which is very small beans compared with what we've seen so far this month. But it is in a difficult position, the Fed, isn't it? Because on the one hand, you've got an economic slowdown, and as we might get onto, you've got pressure from the government, from Trump, to cut rates, but equally you've got inflation expectations rising. There were some really nasty figures on that front from, I think, the Michigan Sentiment Survey this week, and potentially the inflation itself rising. So they're under pressure from both sides, really, and it puts them in a difficult situation.
Yeah, well, the Fed has the dual mandate of unemployment and inflation managing. They want to keep unemployment low and inflation low and stable. And this is a supply shock, so it pushes up inflation expectations, but also brings down growth expectations, which increases the risk of rising unemployment. So they're playing off that balance, which is, if the economy slows, do they then cut rates to try and re-stimulate nominal growth and fend off large unemployment? But if they do that, then it could add extra inflationary pressure to the ones that have already been piled on by the tariffs, which Jerome Powell is aware of, and he's in an almost impossible situation. And he'll be getting a lot of pressure from Trump to cut rates, because Trump won't want the economy to slow down massively. And Trump will continue to put a lot of pressure on him to juice the economy and prevent large scale unemployment. But Powell at the same time won't want to be seen as the Fed chair who let inflation run out of control. And some economists I've talked to have maybe suggested that the risk actually lies on the side of him or Powell not loosening fast enough, because of the fear of inflation, and also potentially the fact that they don't want to bail Trump out of his own fiscal errors. And they're more concerned about rising inflation. And although they might not explicitly be saying to each other, we don't want to bail Trump out of his fiscal errors, there might be sort of human nature, which is that we might wait a little longer than expected to tighten. And then on top of that, there's the rising cost of borrowing in the bond market. So it's got to concern itself with what's going on in the bond market as well. So the Fed is in a particularly sticky spot at the moment.
Yeah. And just before we came on air as well, or just before we started recording, I should say, Trump did put out a latest comment on his social media platform saying the termination of Powell's term can't come soon enough. So really he's saying what everyone knows he's been thinking for a while now. I think US futures are off a little bit on that, but not as much as you might expect. There is this uncertainty as well, I think, as to whether the president can get rid of the head of an independent agency. There's a 1935 case called Humphrey's Executor, which rules on whether the president must show cause to get rid of an agency. That is going to come before the Supreme Court, I think, the next few months in the US, because of Trump trying to fire the heads of the National Labor Relations Board earlier this year, or the head of that board. So there's some uncertainty as to whether the court will say he's allowed to do that with the Fed. I think most people think the Supreme Court will probably say, no, the Fed is its own special case. He can't do that. There's also these questions over when exactly Jerome Powell's term ends, because he's Fed chair until May 2026, but he's a Fed governor until January 28. So this might be something as well that people have to contend with, another big macro issue that causes a lot of volatility in the weeks ahead. We'll see. We're going to finish, though, with a look at our own Supreme Court in the UK, because we're turning to S&U, the motor finance lender. Mark, you've been waiting patiently to discuss them on the show today. They had their full-year figures the other day. As I say, the motor finance issue is coming before the UK Supreme Court, or has been, I think, this week, a ruling coming in a couple of months. There's that uncertainty hanging over the company, but what did you make of the figures themselves, first of all?
Well, I think the figures were really of secondary importance to what's going on the regulatory front at the moment.
Yeah, that's fair.
Yeah, they were fairly decent figures, all things considered, given the degree of intervention in that market over the past year or so. So you had broadly flat revenues, reported profits were down, but then again, that was almost entirely down to loss provisioning under the motor finance unit there. Add back in the 10 million shortfall, and the results seem pretty sound compared to the previous year. And as I say, it was, their business model has been interrupted by the FCA through the year there, and that's had some pretty unpleasant knock-on effects for them. During that period, they've engaged in a little bit of housekeeping, as companies usually do when their main strands of business have been interrupted. So they've managed to reduce leverage a little bit, and operating costs too. I didn't detect any subtext on what the upcoming Supreme Court judgment might have on the business model going forward. Although, it's likely that the risk reward balance, might change over time. It might become a more conservative lender. And these changes may have happened anyway when you think about it, because obviously there's been changes in the modes of ownership within the auto industry. And I think that's something that isn't going to change as well.
Yeah, indeed. The figures, as you say, are very much secondary to the situation, which we'll come on to. But there were also, it also has a property bridging finance business, which seems to be doing quite well in the meantime. So that's picked up a little bit of the slack.
Yeah, it's mitigated things to a certain degree. I guess, rather than the headline figures themselves, if you dig a little bit deeper, there's things like monthly repayments that's fallen by about 6 percentage points year on year, and the net advances has fallen off quite dramatically too, and they're probably a little bit more meaningful to the business case at the moment than what happened in the income statement itself. But as I say, it may be a little bit too early to judge what impact the probe itself and the upcoming Supreme Court ruling that's going to have on the new business over the long haul. But the uncertainty this year, it's eroded the relationship between the lender at S&U and its client base, and this has had some negative effects for the company itself, including their collections business. Because of the FCA ruling there, they haven't been able to proactively deal with their subprime client base in the way that they would normally do. And so, you've got collections going down. And within the text as well, it said there's almost like a psychological change as far as their clients go, who think this process is going through, and so we don't have to be quite so on top of the payment schedule as well. Those restrictions were pulled late last year in October, and there are certainly signs that the business is returning, or at least normalizing from the earlier problems. The recommendations that have been made by the FCA through to the Supreme Court ahead of that July decision, they acknowledge that since 2007, I think it was, nearly all of the motor finance agreements entailed a commission payment to a broker. And of course, the Advantage business, it's on a fixed fee commission basis, which is a positive for S&U. And the FCA also recognised that most of the pending county court proceedings over that period that were reported to regulators on motor finance commission, about 90% of these were generated by commission-driven contracts. So S&U as a company itself is probably a bit better place than some of its peers.
Yeah, certainly on that front. As you say, the other FCA investigation, or the separate FCA investigation, has now ended. That was Section 166 investigation, as they're known, which does tend to be imply, in most cases, the FCA found some things not to its liking in the business, and that's why, well, I think there were voluntary restrictions on the collection process during that period, but it's always sort of hand in glove with the regulatory investigation. But that has now ended, so the company, as you say, is moving on from that and now just awaiting the Supreme Court decision, albeit, as you also mentioned, that in that context, potentially it is better placed because, well, certainly it says, it's got the fixed commission focus, and the court is very much looking at the discretionary payments and the commissions and how they were filtered through the chain and whether they were fair and reasonable to clients. So a lot of things in the mix.
Management said as well that it's got the impression that the FCA itself, and by extension the Supreme Court, is taking a slightly more business savvy approach to this issue now. In other words, they're seeing that there's a potential damage to that corner of the credit market, and it's a necessary corner of the credit market as well. Over the long term, the probe and any consequent legal remedies, they're bound to have a cooling effect on credit creation. Now, how long? Well, it already has, but how long that lasts is difficult to gauge, really. The company itself said that it switched to what our management described it as a lower risk, higher tier customers, and that they comprise about 70% of the loan book compared to 48% a year earlier. But as I say, it's too early to say unequivocally that this will form part of a long-term trend. We're going to have to wait till July, really.
Indeed. I think, their assessments of the business or the more business-aligned approach will certainly reflect, I think, also the fact that there's been this talk about making the FCA focus more on encouraging growth insofar as it can do that. The government as well tried to intervene in the Supreme Court situation. There was an application from the Chancellor in January, I think, which she was urging the Supreme Court not to hand windfall compensation payments to borrowers as a result of this case. I believe the judges have effectively rejected that application, but that's not to say it won't factor into their minds when they're making their decision. Who knows? We'll see what happens, as you say.
The Supreme Court, either side of the Atlantic, is under pressure from the executive at the moment.
Well, indeed. Well, on that note, we've come to the end of the show. Thank you very much, Mark, for your input. Thank you to Arthur and to Mike as well. And thank you to our producer, Maddie Apthorpe. We'll see you next time.